market has punished, to some extent, those of us that have gotten to be very complicated business models. And one of the complications is that you have, which we did in our case, several dozen institutional partners, several dozen funds and programmatic joint ventures with all sorts of different investment communities. So yes, it's a source of capital, and I believe some activity will come, but it comes with it a little bit of a discount from the investment community because you don't control 100% of the asset. The investment community in general would prefer us as the operator to be totally vertically integrated, own, manage 100% of the properties, and preferably the best properties with growth. So you're coming out of the Great Recession, if you will. I think a lot of us are preferring a more simple business model going forward.
You know, also as I can say, our jobs as CEOs is to be custodians of adequate capital allocation. And I think, at least in our business, we don't have the same negative, which is if you did sell off an asset, you're not penalized by the investment community. The walls are quite large, they're $1 billion, $2 billion, $5 billion assets. So you're not penalized for that. And I think you have to judge where there's a delta between the private and the public markets and what's the best way to recycle capital. It doesn't make it that you'll become a seller of the assets, it doesn't make it that you're a buyer. It's just that your job is to allocate capital. And if there's a need for capital, what's the best way to raise capital? That's your job.
Joel, would you haven't done a lot of sort of joint ventures or selling for those assets? Where's your mindset today?
Well, I think that it's clearly something that has to be considered as one thinks about the capital allocation model for our company. We are looking at ways to continue to keep our balance sheet strong. Obviously, with the equity markets, with the discount to NAV, an overused word, that we trade at right now, going to the equity markets is not an option. So yes, we are looking at potential JVs, and maybe not necessarily in our premier properties, but potentially also in our what we would call our core growth assets.
And Joel? So it's going to be Joel and Joe. So Joel?
Yeah, so as I said before, we have been through the cycle in 12 and 13 of recycling assets out of certain suburban submarkets we chose to exit from and reinvest those proceeds in the more core urban finance markets. Going forward, there certainly is, I think, again, because we're an event-driven industry, primarily, there are a couple of things structurally that have moved this industry ahead, even though at the capital markets level it's been pretty robust. One is a much more efficient FDA, so they've approved more drugs in the last 2 years virtually than their entire any 2-year period before that. There's a new path to get breakthrough therapy designation, make it faster, cheaper, and then obviously the onset of some amazingly targeted new targeted therapies. So we could probably be doing 2-3 times, 3x the amount of development we're doing. We don't want to do it because obviously we want to maintain a relatively leverage neutral stance with our balance sheet. So we are looking to do a joint venture on opportunities that really seem unusual and substantial in the market. But by and large, I think our focus is to maintain our Class A assets. They're hard to get, they're hard to construct. In San Francisco, this quarter will probably be 99.9% leased. I can't remember a single quarter in the history of the company being public 16 years when we've been that full. New York City, Cambridge, etc. So our view is not to recycle the best assets, although analysts and investors always tell us, well, why don't you sell this great asset or that great asset, and it'll give you a benchmark on value. Well, okay, that's fine for them, but